Finally today, we want to take you into this alternate universe where big tech has no part in the S&P 500. Katie Greifeld has been digging into it. Katie, first of all, explain the S&P 500. This is a market cap weighted index. So it moves more significantly based on companies that have larger market caps.
That's exactly right. The big guys, they tend to have more say than some of those smaller companies. And if you look at the S&P 500 year to date, it's up almost 12%, which is great. I wouldn't say no to that, but it would be even higher if it weren't for big tech. If you look at an equal weighted version of this index, which treats every company the same, Apple, for example, has the same weighting as Under Armour. Truly a society. It's actually crushing the normal S&P. It's up about 6 percentage points higher than the normal S&P. And what that tells you is that the smaller companies, which tend to be travel, energy, some of those reopening type trades, they're rallying more than the big guys. So in that sense, you're kind of seeing tech put in a ceiling of sorts on the broader S&P 500.
Okay, but this is a completely different story than has played out over the past few years. Because if we look at what's happened over the past few years, growth stocks, the tech companies, that have absolutely led the way. And that's why the S&P 500 and look, the NASDAQ has done so well.
Exactly. I mean, for the past, 5 years, decade, it feels like tech has been going straight up. And I actually want to pick on Apple in particular because that's the biggest company in the S&P 500. It's almost 6% of the S&P 500. And if you look on a year-to-date basis, it's not really doing much. It's pretty much flat. It's actually a little bit lower for the year. And again, that's the biggest player in the S&P 500. So if your all-star isn't really doing much or actually walking backwards, that's going to drag down the entire team, which is the S&P 500.
Okay, so explain how this ties into the growth versus value debate and what growth stocks are versus value stocks, because that's something that we hear over and over again, right? Companies and professionals who bet on growth over value, and sort of the age-old growth versus value debate that we've been hearing.
Exactly. So growth shares, they're companies that they're expected to have earnings in the future. That's why we call them growth shares. And by and large, they tend to be tech companies. But if you look at the value side of things, those are companies, they tend to have earnings that are tied to economic cycles. So now with the economy reopening, economic growth expected to be really robust, you are seeing this rotation out of tech into value, which hasn't happened for a while. And I want to point out the travel companies in particular because they've really been a beneficiary here. If you look at airlines, cruises, hotels, they're the big winners this year. And we actually have an index that tracks that. And as you can see, it's up almost 10% just in the last 2 weeks as people look to the summer, start to book flights. I actually just booked a flight for the first time in a long time last week, and apparently everyone else is too.
Yeah, I'm a little jealous. I need to start traveling. You talk about small caps too versus the large cap companies, and one thing that we've been following this year has been the outperformance of the Russell 2000, an index that follows the small caps. Russell 2000 is higher by more than almost 13.5% so far this year. It's outperforming the Dow, it's outperforming the S&P 500, and outperforming the NASDAQ. Small caps having a moment.
Well, that's the thing, Tim. They were crushed last year because you saw the pandemic really batter those smaller companies that don't have those big cash buffers. That's mostly been the tech names. So just because that drop was so big, those are some of your biggest performers this year, especially as we look to a summer where people are traveling and spending money.